Innovation continues despite an uncertain housing and real estate market. One such product could be seen as a reverse mortgage in your pocket. NerdWallet reports on Bloom's prepaid MasterCard launched earlier this year. What happens when one can access their home equity with a swipe of a credit card? That's the question that columnist Clay Jarvis had since the reverse mortgage provider Bloom Finance Corporation launched their Bloom prepaid MasterCard in March of 2024. It's an innovative tool, but is having such easy access to one's home equity the right choice for cash-strapped homeowners? In many ways, the card operates like a typical reverse mortgage. Bloom determines the amount of money they're willing to lend based on the age of the homeowner, the amount of home equity that is held, and the location of the house being mortgaged. The money borrowed plus interest is paid back when the home is sold or the last borrower passes away. You can pay the balance earlier if you have the cash available, but you must be willing to incur prepayment penalties. Withdrawing funds is where this card carves a new path in lending. With a typical reverse mortgage, you may receive perhaps a partial lump sum or a full lump sum payment, or you can draw from a line of credit. But with the Bloom prepaid MasterCard, you can choose just how much equity would be loaded onto the prepaid card each month. You can spend those funds anywhere that would accept a credit card, which is nearly anywhere. According to Bloom founder and CEO Ben McCabe, the company's ideal scenario is to have the borrower make their reverse mortgage funds last up to 10 years by drawing, for example, $2,000 a month. The most intriguing aspect of the Bloom card might be just how much control it gives the borrower to tap into their equity. The risk is it may lead to overspending. The beauty of this product is that it's not mandatory to draw on the card, says Shane Hussein, principal broker at HVR Financial. And unlike a typical reverse mortgage, which does accrue interest the moment that a lump sum payment is made, Bloom only charges interest on the amount that is withdrawn. So if you don't use your card, you won't owe Bloom anything. Though at this point, you would already have paid $2,300 in administrative fees to set up your card. However, it should be noted that a home equity conversion mortgage's line of credit also does not incur any interest on the unused portion of that principal limit or available line of credit. The Bloom concept is interesting for its convenience and how they allow the homeowner to tap into the funds that they're going to be borrowing. So there is definitely a convenience factor. At the time of NerdWallet's column was written, Bloom's rates range from 6.94% on a promotional 5-year fixed rate to 8.39% for a promotional 1-year fixed rate. Now, you cannot, however, simply just pay off your Bloom card like you could with a credit card. You can pay off the interest that is accrued on the withdrawals, but you can't pay down the principal balance without encountering any prepayment fees, and Bloom makes that very clear to their borrowers. Today, some reverse mortgage lenders are facing significant liquidity pressures. And this is not surprising considering higher interest rates are hastening when a HECM loan reaches 98% of the maximum claim amount when it must be purchased back out of the HECM-Mortgage-Backed Security pool. Now, the challenge is when the lender must carry that HECM loan that they've purchased out of the pool until the loan is assigned and then eventually reimbursed from FHA's insurance fund. That is the purpose of FHA insurance. The time between the buyout and reimbursement can range anywhere from several months to even years when it's complicated by unpaid property charges or a foreclosure after the death of the last borrower. Ginnie Mae is well aware of such challenges, having assumed reverse mortgage funding or RMF's HECM servicing portfolio in late 2022 in the wake of that lender's collapse. Shortly afterward, the agency began developing HMBS 2.0, or the second version of its HECM-Mortgage-Backed Security program. In its June 27th policy spotlight, Ginnie Mae spells out some of the particulars of the program in its term sheet, which was recently announced. And here's a short summary. HECMs eligible for HMBS 2.0 must meet all of the following criteria at pooling. Number 1, the HECM unpaid principal balance must be no less than 98% and no greater than 148% of the maximum claim amount. Active buyouts and non-active buyouts are in fact eligible. Second, FHA HECM insurance must be in full force. Third, each HECM must have received final certification from the respective document custodian. Fourth, each HECM must maintain its first lien position. That means no other lien can be put in front of it and be fully enforceable for the life of the HECM loan. Fifth, the maximum adjusted property value ratio is 60%. And sixth, subsequent participations from eligible HECMs are also eligible collateral. Ginnie Mae Senior Policy Advisor Karan Kaul writes, access to liquidity under HMBS 2.0 will give issuers time to resolve issues that prevent HECMs from being assigned to FHA. This access will relieve immediate liquidity stress and reduce the likelihood of issuer default and portfolio extinguishment, where Ginnie Mae is required to step in and take over the portfolio from an insolvent issuer. In this process, in turn, it would help improve investor confidence in the HMBS market and support HECM MSR values. In the final analysis, this is great news for our industry, and the sooner that this policy or this HMBS 2.0 program can be put into place, the more of a solid footing that all of our issuers will be in. So congratulations to Ginnie Mae for moving quickly on this, and we hope to see final enactment in the coming months, certainly by the end of this year. And in our final story, if you are in the process of prospecting for potential HECM for purchase borrowers, this next story should grab your attention. A recent column in Yahoo Finance notes that retirees are no longer moving in droves to Florida or Arizona. In fact, many are leaving Arizona. Indeed, saving for retirement has recently become difficult due to inflation and high interest rates, which has put pressure on the cost of living and left little money to put aside. And that's why finding a location which can stretch your dollar while not sacrificing your quality of life can be tricky. So here are some of the states retirees are moving to that are not Arizona or Florida. First is Texas. A managing director of a real estate firm, John Peria Upscale, said that the Lone Star State is one of the most popular states for seniors to retire in. What makes Texas most appealing for those living on a fixed income is the affordability of such basic needs as housing, transportation, groceries, and utilities. In addition, there is also no state income tax in Texas, and the state offers property tax exemptions for senior citizens and military veterans. The next state where seniors are moving today is Pennsylvania. U.S. News & World Report's Best Places to Retire lists 5 of the top 10 spots as in Pennsylvania. These places all offer very high quality of life, great healthcare systems, low cost of living, and low taxes. And most importantly for retirees, Pennsylvania does not tax income from pensions, retirement account withdrawals, or Social Security. And the next state that retirees are relocating to is North Carolina, especially for more expensive regions in California and the Northeast. There are many reasons for this relocation, such as reasonable real estate prices, a temperate climate, great and diverse outdoor activities, and decent and diverse cities. And the next state where retirees are relocating came as a surprise to me, the state of New York. And one area in particular is the Hudson Valley in the Catskills region of New York State. And that is where many retiree buyers are looking to live out their golden years. One expert says the Hudson Valley in the Catskills region is just north of New York City and serves as an easy vacation destination for many urbanites, and that can give many towns the feeling of being on vacation all year round. Many also love having access to outdoor activities such as hiking, biking, swimming, boating, and skiing. And that concludes another episode of HECM-World Weekly. Thank you for joining us. We do have an audio edition of this podcast, which you can listen to here at HECM-World or on Apple Music, Spotify, or Podbean. Be sure to return next week for the nation's only weekly podcast, bringing you reverse mortgage-related news to you, the mortgage professional. Have a great week.